Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, Mena and I today would like to talk about tax strategies to maximise your borrowing capacity. You know, the funny thing is that quite often we think investment assets are the scarce element when it comes to investing. But the reality is that borrowing capacity is probably your most important scarce asset, which is to say that everyone has a certain amount of borrowing capacity, whether that's dictated by your own risk profile, whether it's dictated by your cash flow position, or whether it's dictated by the banks. But everyone has some sort of limit on how much they can borrow. And then the question then becomes, how do you firstly maximize that scarce asset? And then how do you allocate that as efficiently as possible? And I think that's really critical, right? If I've got a certain amount of borrowing capacity, I want to use it for assets that are ultimately going to help me achieve my financial goals, which means living in an area or a type of home that, is going to suit me or that I desire, or that borrowing capacity is allocated to assets that are going to give me the most amount of return. So today what we want to talk about is, as self-employed individuals, self-employed people, how do you go about maximizing your borrowing capacity? Now, of course, we need to think about cash flow. So we're not suggesting here that you need to go and borrow to your eyeballs irrespective of whether you think you can afford it and make the repayments. Of course, that's an incredibly important element. But the issue that we find mostly, particularly with self-employed people, is that their accountant hasn't perfectly understood, their own personal goals and then what the banks look at. And as a result, it limits their borrowing capacity. And that's really where we wanted to focus today's conversation.
Yeah, and I always refer to this as a double-edged sword. An accountant is sort of programmed to sort of minimize your taxes at all costs, and you can't minimize your tax and also sort of borrow the max you could based on your income. So it really comes down to sort of a holistic approach to understand, does your accountant actually understand banking policies, and does he work with a broker who can sort of understand your business and what you can do and which bank we should approach to actually maximize your borrowing capacity. So some typical strategies with employees, increasing sort of taxable income strategically. And this could involve things such as delaying deductible expenditures, so like postponing them to the next financial year. So this could include things such as repairs or creditor payments or something like that, just to help basically the expense appear on the profit and loss for the next year. And essentially you're just averaging the income out over the 2 financial years. Or conversely, you could also bring forward income. So, you could invoice for work before you complete it, as an example. Or, sometimes a tax planning strategy is actually to delay invoicing till the next financial year. But maybe you want to bring that forward just to increase your taxable income so that, when you come to take up a loan with the bank, that they can actually see that income on your P&L. Another thing is minimizing salary sacrifice contributions to super. Now, some banks would add that back and some banks won't. So having your accountant working with your mortgage broker to understand if your bank particularly doesn't add that back, then maybe it's a case that we don't do it in the company and we make the contribution personally instead. Now, another consideration is around distributions. Some banks don't allow you to distribute funds outside the family group, and if you do, then their income's not recognised. Now, with some banks, we know how to mitigate this, by providing certain accountants' letters and reasonings and logics as to why we do this, but not all banks accept that. So it's really important to understand the nuances of each bank, and that basically not everything is just about tax. Also, helping your overall wealth position, how to get those funds to build your wealth.
And the mistake here would be to think that banks are logical. That if you structure your business in a certain way, or if you've got a non-cash tax deduction that hasn't impacted your cash flow, like depreciation, for instance, that the bank is going to understand that. The reality is that some people in the bank will, yes, many won't. And you would be surprised about some of the questions that we get from banks. Similarly, if they have a credit policy that dictates a certain treatment, even if that treatment, and often is, completely ridiculous and devoid of any logic, it's like you sometimes banging your head against a wall. Like sometimes you're just not going to win that argument. So when speaking to your holistic accountant, if they say, oh yeah, but we can talk to the bank about that, we can explain it, that could be possible in some situations. But in some situations, that's not going to be the answer. It's either do it their way and maximize your borrowing capacity or don't. So that's an important thing to think about. In addition, loan structuring is incredibly important too and can have a big impact on your own borrowing capacity. So obviously working with your accountant, that's also going to work together with your mortgage broker to make sure that the loan is structured in a way that is both tax effective and also cash flow effective, that ultimately increases your borrowing capacity. And it could include consideration of a number of different steps, resetting loan terms or converting loans to interest only, or sometimes even from interest only back to principal interest. But certainly resetting loan terms sort of extends the loan term, which really minimises the minimum repayments. And there's a few lenders now that offer 35 and 40-year loan terms, and that can certainly help in terms of borrowing capacity. Debt recycling, which is, just as a general way, a consequence of debt recycling is that you convert non-tax deductible debt to being tax deductible. Now, of course, most banks include negative gearing when they're calculating borrowing capacity. So that is, they include the fact that some debt will attract a tax deduction, and that can improve your borrowing capacity. Using offset accounts rather than reducing debt, again, that gives you the flexibility to preserve the original tax deductible characteristics of that debt, whilst also still minimising interest from time to time, and potentially prepaying interest. Sometimes that can help both in terms of serviceability and tax deductions. Be careful there. Sometimes it's like kicking the can down the road, but in some situations, particularly if you've got some volatility or variance in taxable income from year to year, it can be a strategy or an option that you can utilise.
And finally, choosing the right investment structure. So different structures actually yield different sort of borrowing powers. So for example, when you own an investment property personally, then your income's fully assessable, but also the banks factor in the negative gearing benefits. Whereas in trusts, for example, because the losses are trapped within the trust, it basically limits a lot of lenders, and they also require personal guarantees. So your serviceability actually can drop as a result of that. Now, there are certain benefits when borrowing in trusts. For example, there's banks out there that might not consider debt outside the trust as long as there's a personal guarantee in place. So sometimes they're beneficial, but not always. Similarly with companies, they'll recognise salary and wage income, they'll recognise profits, but they might not recognise the retained earnings. So again, working with banks that understand financials, and you'd almost think, I remember when I started out in accounting a long time ago, Stuart's laughing, but when I started out in accounting, I started dealing with banks. I always thought, they'd have a good grasp of financials and structures and so forth. But unfortunately, with a lot of bankers and credit managers, it's all just about ticking the box. And if the financials don't line up with the boxes or their experience, then it basically just becomes too hard. So it's really important to deal with, again, a mortgage broker that can go bat for you, as well as with banks that actually can understand sort of self-employed structures.
I think the key here is, and it's a common theme, hopefully in all our podcast episodes, given it's called The Holistic Accountant, is that a holistic approach is what's going to work here. You really need your accountant and your mortgage broker, and if you're getting financial advice as well, everyone on the same team. And the benefit of that is they can understand your goals and what is important over the next 12 months in particular, particularly if it's going to give rise to additional borrowings or refinance or restructure and these sorts of things. And then they can prepare a few different sort of scenario analysis. I mean, the accountant can sit down and go, well, if we structure the client's affairs in this way, what's going to be the impact on borrowing capacity? And then they can workshop different strategies and approaches that are ultimately going to level out or balance out, being able to achieve their financial and lifestyle goals at the same time, making sure that in the short, medium and longer term, they're optimising their tax position as well. Now, that's really difficult to do after the fact. So you don't want to go and lodge your tax return and then go and shop it around to a bunch of different brokers to find out, what is the outcome. You're better off to do that up front, particularly if you know that you're going to be relatively sensitive to borrowing capacity. And again, that's the scarce asset you want to maximize is borrowing capacity. It really is an asset because you can use it as a means to not only improve your financial position, but obviously achieve your lifestyle goals as well. Okay, we'll leave it there for today. And until next week, bye for now.